Hey folks, Saransh from Wisdom Bites here. In this episode, we'll continue our discussion on investing from the previous episode. If you haven't watched it, either here or here, it should be linked somewhere. First time doing this, not sure which one's the right place, but you'll find a link for sure. In this episode, we'll talk about investing in terms of stock market, and we'll talk about how to choose the right stock. The things that I'll cover are what exactly is a stock, why you should be buying a stock, what makes a stock price move, how to pick a stock, and how much should you be investing. Hope this helps get you a fair idea about things that you should know about investing in the market and also helps you choose the right stocks. There's a lot of things that I'm intentionally ignoring right now, but this should be a good brief overview and introduction of the stock market. Let's get this discussion started with what the hell is a stock anyway. Let's suppose we come up with a brilliant startup idea. We launch it to the world, it's ultra successful. We start making money, but it is not enough to expand quickly. Our competitors start catching up and we need more money to grow fastly. Also, let's assume we don't have any private investors involved in this hypothetical scenario, but we do have credibility that we can enough credibility that we can sell a portion of our company. We can use this money for our expansion needs and crush the competition. Let us say our company is worth $1 million. Nah, that would make the calculations too complex. Let us say our company is worth $1,000 and we decide we'll divide it into 100 stocks of $10 each. We then sell 10 of our stocks to an investor for a total of 100%, $100. He now owns 10% of our company and we have $100 to use as we want to. Finding such investors does not happen in a closed room. It instead happens via a listing on the stock market. Stock market or stock market exchanges help facilitate this buying and selling of portions of companies. A couple of the renowned ones here in the United States are New York Stock Exchange and NASDAQ. When the company lists their stock for the first time, they do what is called an initial public offering or an IPO. The participants who buy at this point then keep buying or selling these stocks according to whether they like the company or not. And that is what creates a stock market wherein there's multiple participants who are buying or selling stocks of different companies, therefore creating a supply and a demand for a company's stocks. And that's how you essentially trade stocks. Now, there can be some fraudulent activity involved during this whole process. So to keep everyone in check and to facilitate these transactions of stock exchanges, we have middlemen known as brokers. So that is what your broker is doing for you for a commission fee. They are acting as the middlemen so that you don't have to worry about a lot of things. You can use various brokers. I personally use Robinhood. And if you're in the United States, or I think they are in a few other countries, I would suggest using Robinhood. It has a very easy to use mobile interface. It has its drawbacks, but I think the free commissions and other features outweigh other drawbacks, and they've become better over the years. I'll put an affiliate link in the description below. If you use that link to sign up, I'll get a free stock and you'll get a free stock. It just helps both of us if you don't have an account yet. If you do, it's perfectly fine. No need to worry about it. The next question that we'll discuss is why buy stocks? A stock is a share in the company. If the company does well, you get a percentage of the profits that the company made. This can be in different forms. The price of the stock will increase substantially or in proportion to the profits, or you can get a dividend. A dividend is the company paying you small amounts of their profit for holding the stock. As the business keeps growing, the value of your stocks keeps increasing. And that's why you should be buying stocks. You're making a company work for you and taking in the profits from their revenue or a portion of the profits. This helps you make more money and also beat inflation, because whatever you're buying right now, let's say if I have $100 in the bank and I can buy $100 worth of stuff right now, because of inflation, it will be $102 in the next year, considering 2 to 2.5% inflation year over year. So you want your money to make more money, because cash in the bank is always going to depreciate or in the longer run. I also cover other things about investing in the previous video, but essentially you want your money to make more money for you, and who doesn't like making more money, right? Now that we understand what a stock is, what makes a stock price move, the fluctuations of ups and downs are just, there's too many every day. And even though it's mostly supply and demand of various participants in the market, these participants can be individuals, companies, or even the bank itself. But these factors, these movements are influenced by a lot of factors. The factors that influence are not just the company's financials. The price of a stock almost never accurately represents the true value of the stock. There's always a future element associated with it, a future representation of what the company is expected to do is factored into the stock's price, as well as the market sentiment about what will happen in the near future with respect to that company determines the price range of the stock. So supply and demand does play a lot of role in this, and determining the true value of a stock is complicated because of all of these factors. Then throw in interest rates and a lot of other moving vehicles. The price keeps juggling between ups and lows, and that is what determines a company's stock price movement. If the sentiment goes negative, if people are thinking that the company will not do well in the future, they'll start selling the stock and the price will start going down. If there's anticipation of the company doing well in the future because of some metrics or just sentiment in general, people will start buying it and the price will start going up. Next up, how do we pick a stock as an investor? We want to buy into a company that has a brighter future, but it is being undervalued by the market or Wall Street in general. A good way to figure this out is to understand the cash flow of the company and also factor in a company's year-over-year growth. This can be done by reading the financial statements, understanding the company's business models, and a lot of other things as well are involved as well. The other things to look into are the company's management team and how much you can trust them, their competencies and their efficiencies over time to handle the business of the company. They will eventually determine if the company succeeds or not. A lot of this also has to do with incentives. If a lot of insiders own the shares of the company, they are invested in the company as well, and they want to do it, and they want the company to do well too. Those are the things that I typically look at when buying a stock, although I usually do options and stocks. But these are the building blocks of how to pick a stock and how to decide what company to go for. There's this definition is known as fundamental analysis of a company. There's different strategies apart from this, but this is a long-term strategy which involves looking at the financials, doing qualitative and quantitative research about the company. Other strategies which are used by different types of investors are technical analysis, which are a bunch of graphing techniques which are useful in the shorter term. Then there's passive funds, people who invest in ETFs year over year or month over month, depending on how they want to invest, without worrying about the price fluctuations in general. This can also be applicable to stocks. If someone likes a stock, they can just keep buying a stock on a fixed date every month. That is known as dollar cost averaging, wherein you keep averaging out your price for the stock. This is known as passive funds, and that's one way of investing as well. The fourth one is behavioral analysis, wherein people get into short term trades on the basis of news or upcoming news that is about to be announced in a few days. This is Wall Street also calls this pricing in an event. Mostly they try to predict what is going to happen and do investing in that terms. So if the sentiment is going positive, I'll go with the momentum and start buying, because I before the announcement actually comes out, I'm anticipating people to keep buying, and vice versa for selling. The last question that I want to answer is, how much money should I be investing? I think more than the amount, what matters is getting into the habit of investing itself. There are a lot of articles which say you should be investing 10% of your income, 20% of your income, blah, 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 blah. What is important is that investing is a marathon, and you have to get into that mode. You have to start doing your research and start investing in the money. You can start with as little as $25. The amount doesn't matter. You have to get used to buying and selling, putting in the money and seeing how you react in the ups and downs, testing out the waters with your emotions and how you handle things. There's a very common saying that time in the market is always more than timing the market. So try and put some money into it, make some money, and you'll also realize how much you want to invest in the future. Because once you see that you're making money, or if you start losing money, you decide this is not something I want to do. So get started as early as possible and don't do paper trading. You can for a while to learn things, but put some real money in so that you get to see what your emotions do and how you are able to handle ups and downs. I would also recommend defining profit percentages. So if I make 10%, 20%, whatever the number for you is, I'll just exit from this trade. Or if I lose 20%, I'll just quit from this trade, because otherwise, when to sell is also another question which most people don't have an answer to. So instead of doing it aimlessly, set numbers for yourself that if a trade makes this much of money, I'm selling it. If it goes below this much, I'm selling it. So 15% is what I use. It's been 10% for me in the past. I've increased it to 15 these days. I've done 20 as well. I also sometimes vary it according to the stock. If I'm investing in volatile stocks, I'll probably have a bigger range for those, but I do define those whenever I'm entering the trade itself so that I don't screw it up in the future, because your emotions will always come into the picture when you reach that amount, and you'll be like, hey, let's squeeze a bit more out of this trade, and that might or might not work out. So I would definitely recommend setting ranges. As you've seen already, picking a stock and sticking with it and making money off of it is not as easy of a journey as a lot of people think it is. And there has been an array of YouTube influencers and a lot of market gurus who have portrayed that it's very easy, you just pick a stock and you make money, but stocks do not always go up, they go down too. And we've been in a bull market for a long time, but nobody knows what's going to happen. Do not think that the articles about if you had invested $1,000 in the market in Netflix stock, Nvidia stock, fill in the blank stock, then you would have $10,000, $30,000 this in 2021 if you had invested 1,000 in 1990s or something like that. Fool you, because the stocks do go up, but they also do go down. Your emotional capabilities determine if you're able to stick to it or not. A personal example, I bought Enphase Energy at $26 and sold it at $52, and I made 100% return, and I was super happy with that. Today it is $150, $160 or something in that range, went up to 200 something, but I got out early and I'm still happy with that decision. I invested on the basis of some Reddit discussion I read, and 100% was good enough for me, and I'm happy with that. I didn't it's all relative. You could buy a stock at 100, it could reach 200 and you feel like selling, you make your money, get out. It goes up to 300, you will have the fear of missing out. It goes down to 100, you'll feel good about yourself. Timelines matter in investing and emotions matter. It's what works for you. Define your strategies and stick to those. Don't just read articles. In fact, personally, I believe analysts are not helping us that much. You should definitely listen to what they're saying, but not rely on them. Referring them is okay. Relying is stupid, because they themselves are out there to make money. They are looking for out for their own, not you. So don't just think that everyone says this is easy and it works. Yes, we've been in a bull market, but nobody knows what the future holds. So be careful and just trade small, trade often is something I follow, but that is my strategy. Everyone has their own. Don't listen to any analyst, including me. I'm just a guy who's a bit more experienced than you, but always do your own research, your own due diligence, define your own timelines and stick to them. And that is all I had to cover in this brief video. I hope it helped you get an idea of things that you should see when you are trying to pick a stock and how a stock's price moves up and down. There's a lot more things that go into it, which I have intentionally ignored because of the beginner nature of this video. There's interest rates, there's earnings, there's a lot of things that go into it, but these are the building blocks of picking stocks. Then you have a lot of information that you can learn from the market, from a lot of sources. So once you know the basics, then only you can go on the advanced stuff. I mostly use options. I don't even do stocks most of the times, but that is a separate discussion for another video. If you have any questions, join the Discord. The link will be in the description, and hoping to see you there. Also, it would be great if you can subscribe to the channel. I'll be posting more investing related videos in the future, so you get a notification whenever I post. And thank you for watching the video. Hope it helped. See you next time.